YouTube videos that talk about money usually fall into two categories. The first one are those long, complex and boring videos about economical concepts that usually leave you more confused than you were to begin with. The second category are those videos that are outright scams, promising you thousands of dollars in passive income if you would only sign up for this course or buy that guide. Those don't give you any value, and of course the ones that are getting richer are the creators of those videos. Seeing all of this, I felt I wanted to make a real video covering in simple terms the bare basics of how money works and how you can make more of it without selling you on any course or any guide. Hi everyone, I'm Nevo, and on this channel I help you achieve your goals by gaining financial knowledge and life-changing skills. So the first basic principle in order to make money in other ways besides working is that you need to at least have some of it in the first place. Meaning that the first rule of money is that at least at the beginning you need to actively earn it. This is called active income, and simply put, it's work. Whether you flip burgers at McDonald's, drive an Uber, or work as an engineer, you're making money. And that's the key here. Earning those first bucks is the base to any financial decision you'll make down the road. Now, obviously, choosing what to do in life is a super important decision that will impact your future. If you're very interested in a specific topic, I highly encourage you to pursue it. Learn as much as you can about it and try and turn it into your job. It can be something common, like if, for example, you're interested in business, then you can go ahead and study business administration like I did and work in the business world. Or it can be as wild as, for example, I have a friend who really likes lettering and is making fonts for a living. No matter what you end up doing, you need to understand that there are two important things here. First, you need to understand that this step requires hard work. Yes, you're not going to drink martinis at the poolside all day long, but you're taking your first steps to assure your financial future. The second important thing is that although you make money, you need to make sure that you manage to save some of it. If you're out there working like crazy and making even 20 grand a month, but end up spending 25, then of course you're only making things worse for you and you won't have any money to invest. So if your expenses are higher than your income and you see that you end each month with a negative cash flow, there are a lot of things you can do to cut back on your expenses. And actually, especially for that, I did an entire video where I explained how to save and cut on your expenses in 4 simple steps. I'll put a link to it down in the description, so make sure to check it out. While you earn money and manage to save some of it, the second money rule comes into play, and that is to invest it. Now again, here there are so many scammers out there that will try to sell you on investment courses and get you hooked on NFTs, cryptocurrencies, forex trading. The buzzwords are really endless, but I've made this video especially to help you cut through that noise. Warren Buffett was an investment guru and a multi-billionaire with a net worth of over $100 billion, once said, "Don't look for the needle in the haystack, just buy the haystack." I myself have a degree in finance and my major was in the capital markets, meaning the trading of stocks and bonds, and I know trading inside out. Now I can promise you that almost no one out there can outperform or get better returns over a long period of time than simply investing into the S&P 500 index. This is the simplest thing you can do. It's literally just a matter of few clicks on your computer and you're guaranteed to make money in the long run. I can make a whole video about the S&P 500 index. And if you want me to do so, let me know down in the comments and I will make one. But just in a nutshell, so you know what it is a collection of the 500 biggest public companies traded on US stock exchanges. Companies like Apple, Amazon, Microsoft, Google, Tesla, Meta, MasterCard, Chevron, Coca-Cola, Bank of America, McDonald's, Walmart, Salesforce, Nike, Netflix, Starbucks, Boeing, Intel, and many more huge companies. When buying the S&P 500 index, you're basically investing your money into all of those huge companies that are highly profitable. And you don't care which of them had great returns because you bought them all. And that is exactly what Warren Buffett meant when he said to buy the haystack. Now in this video, I'm not going to go into all of the benefits of buying a passive index fund like the S&P 500, benefits like diversification, low fees, passive management, and sectorial exposure. But I am going to tell you this. In 2008, Warren Buffett placed a $1 million bet with 5 of the most sophisticated investors on Wall Street. Those were 5 managing partners of hedge funds. Now, hedge funds are the investment vehicle of the most sophisticated and ultra-wealthy people in the world, often with a minimum required investment of over $2 million. Mr. Buffett's bet was simple. He argued that in the next 10 years, the S&P 500 no-brainer investment is going to have a higher return than each and every one of those 5 hedge funds. Now you need to understand just how ludicrous of a challenge that is. Hedge funds are known to hire the best talent from the most prestigious business schools in the US to develop their investment thesis for their investments. We're talking about graduates from Stanford, Harvard, Yale, and so on. These are highly educated people and oftentimes much smarter than the average investor, and they have only one goal in life: maximizing returns for the hedge fund. So the bet was underway, and after 10 years, the results were the following. The first fund achieved a return of 2.8%. The second fund achieved a return of 7.5%. The third fund achieved a return of 8.7%. The fourth fund achieved a return of 28.3%. And the fifth fund achieved a return of 62.8%. Now, can you guess what was the return of the S&P 500 during those 10 years? It was 85.4%, outperforming each and every one of those highly sophisticated hedge fund managers and more than 10xing the first two. So you can take my word that the S&P 500 is the best place to park your money at. But now you know that you can take Mr. Buffett's word for it as well. Okay, now this is important, you guys. If you like this video so far and you want to get more content like this with real value that gets you one step closer to your financial goals, make sure to hit the like button and subscribe to the channel. It supports me in making more content like this, and it will make sure that you won't miss any future uploads. So make sure to do it right now. After earning and investing comes the third and most important rule of money. Don't do anything. Literally. Now, of course, I don't mean stop working or stop investing. But what I mean is don't sell your investments. In 2020, Fidelity, one of the largest brokerages in the world, wanted to find out what is the profile of its most successful investors. The investors that were making the highest returns over time. Can you guess what was the common thing among its top investors? Well, they were all dead. Now, I know it may sound crazy, but hear me out. Because they were dead, they just never sold their investments. No matter how loud the media screamed about a coming recession or a downturn that's right around the corner, they just didn't panic. Now, obviously they couldn't, but they didn't, and they didn't sell. And this is the key for making money off of investments. Don't sell. Remember Warren Buffett from earlier? Well, in one of his most famous quotes, he said, "The best time to sell is never." And that lines up perfectly with Fidelity's research. We as human beings are prone to be affected by the herd effect, in which a person acts like the people around him and emulates their actions. There are dozens of researches about it, but basically, throughout history, that is one of the traits that really helped us survive. In investments, being affected by the herd effect is the worst thing we can do to ourselves. The economy has trends of going up and going down, but overall it has a positive trend where it expands and stock prices go up. But if you panic and sell at the lowest point when a downturn comes, which a lot of people tend to do out of fear and uncertainty, and also exaggerated by the herd effect we were talking about before, you're guaranteeing yourself the worst possible outcome, losses. And indeed we can see that even in the biggest market crashes, like the 2000 tech bubble, the 2008 housing crash, and even during COVID, the stock market got back and recovered within a few years and sometimes even within a few months. All of this is to say, after buying, keep buying more. And don't sell unless you absolutely have to. So now, you're probably asking yourself, wait a minute, if I only buy but I never sell, then when do I get to see my money? And that's a great question. Ideally, you'd want to save and invest as much as you can. And once you decide to start using your savings, you can apply the 4% rule. The 4% rule is an outcome of a study conducted in Trinity University in Texas. Basically, what the researchers wanted to know is what is the biggest amount of money you can withdraw from your savings account each year without it running out of money. Now this is interesting because keep in mind that as we saw earlier in the video, stocks have a positive return over long periods of time. So there is an equilibrium in which those returns can make up for the money you withdrew from your savings account and essentially keep your portfolio intact. Now because capital markets are volatile, meaning that in some years they perform great, but in others they crash, the researchers tried to find the optimal portion that you can safely withdraw from your savings account so that that volatility doesn't cause it to run out of money. After doing a lot of research and backtesting their findings with actual returns of over 70 years, they found out that a withdrawal of up to 4% off of the portfolio for the first year and the withdrawal of that same amount adjusted for inflation for the years after that led to the portfolio still having money in it after 30 years. And all of that without any new contributions, and on the contrary, after withdrawals. Now that is a very famous study in the finance world, and because of its findings, experts recommend that you withdraw up to 4% off of your savings in the first year, and then that same amount adjusted to inflation in the years after that. So you can feel comfortable doing so as well. By doing this, you're basically creating yourself a well-oiled money printing machine that's guaranteed to continue and printing you money as long as you withdraw only those 4% a year. So in this video, I've mentioned many investment terms that can be quite confusing. Terms like stocks, hedge funds, inflation, indexes, and so on. If you're not familiar with them, it's perfectly fine. To have you covered, I've made an entire video about the basic investment terms every beginner investor should know. So make sure to check it out right now.